You are listening to The Vocal Technologist. Spoken tech for your ears.
I just spent the morning looking through some of the market reports, and I have to say, the daily price action is like riding a rusty old roller coaster.
Oh, absolutely. The charts are trying to give everyone a heart attack.
They really are.
But if you look past that immediate stuff, which, let's be honest, is usually driven by things outside of crypto, what's really happening is fascinating.
Yeah.
The amount of, strategic building and high-stakes regulatory moves, it's a lot. We have a ton to unpack this week.
We really do. So I think our mission today is pretty clear. We need to cut through all that market anxiety.
Right.
Let's focus on the real shifts, the tech that's actually launching, and of course, the regulatory battles that are going to define Web3's future. Welcome back to another exploration from the Vocal Technologist team.
Sounds good. We can start with, the market mood, because there are some wild contradictions in where the institutional money is actually flowing.
And then we can get into the infrastructure that's trying to solve this fragmentation problem.
Yeah, before we do a serious look at stablecoins, the risks, the rewards, and their surprisingly big role in geopolitics.
Okay, so let's start with that market mood. The main signal, if you just read the headlines, is pure panic.
It really is.
The crypto fear and greed index plunged to, 10? That is extreme fear.
You only see that after a major crash, usually.
Exactly. And Bitcoin, which is supposed to be the resilient one, it dropped hard, slipped well below 100K, down to 96,000.
And that anxiety wasn't just, retail traders. It hit the institutions hard.
Yeah.
We saw a historic reaction.
How big are we talking?
$2 billion in outflows from global crypto investment products in 1 week.
Wow. And just to give you some scale on that.
That's the largest weekly exit we've seen since early February.
And what's really wild, or maybe terrifying, is the concentration of that flight.
Oh, yeah. The U.S. was responsible for 97% of those redemptions.
97%. So Bitcoin funds saw about 1.4 billion in withdrawals. Ethereum lost almost 700 million. So you got to ask, right, what hit the U.S. so hard, so fast?
It was the Fed, the Federal Reserve. I mean, if you connect the dots, the main driver was this sudden change in thinking about interest rate cuts.
Right. The probability just collapsed.
It collapsed. In 1 week, the chance of a rate cut this December went from 70% down to 42%.
When the cheap money train stops, institutions just trim risk everywhere.
Exactly. They sell everything. And crypto is just caught in that macro storm right now.
So it sounds like this big organized retreat. But at the same time, we're seeing this amazing counter-narrative, aren't we?
We are.
It's not a full retreat from crypto. It feels more like a rotation within it. How do we square that? A $2 billion outflow on one hand, and some of the biggest funds in the world are buying more.
You look at who is buying and what they're buying. Take Harvard.
The endowment fund.
The endowment, yeah. Manages about $57 billion. They just tripled their spot Bitcoin ETF holdings.
Tripled them.
To a staggering $443 million, specifically in IBIT, the BlackRock one.
And let's just pause on that. For you listening, that holding is now Harvard's largest single declared U.S. public equity position.
Right. Ahead of Microsoft. Ahead of Amazon.
So they're treating Bitcoin less like a wild bet and more like a permanent blue chip asset.
Yeah.
That's a serious signal.
It is. And it's not just Bitcoin. Look at the altcoins, especially Solana.
Okay.
We saw spot Solana ETFs kind of quietly rack up 16 straight days of inflows.
16 days.
Totaling over $420 million. That tells you that allocators are de-risking from Bitcoin because of the rate stuff. But they're moving that money to find higher yield in alts. The money didn't vanish.
It just moved down the street.
They just moved houses, exactly.
And what about the core infrastructure itself?
Yeah.
Like true belief in the tech. We always look at Ethereum staking for that.
And despite all the price mess, the amount of ETH locked up in staking just hit a new all-time high.
Wow.
Over 33 million ETH. So people are comfortable locking capital up for years to earn yield, which shows this really deep commitment to the network.
So what this really means for you is that the scary headlines are mostly coming from traditional finance reacting to macro news.
Right, while the long-term targeted money is just quietly accumulating. It's panic for some, but a huge opportunity for others.
Okay, that brings us from the market chaos to the actual engineering. And the focus here is efficiency and consolidation.
It has to be.
I mean, we have over 25,000 fragmented tokens out there. $70 billion in altcoin unlocks are coming. The industry's just It's a mess. It needs to simplify. This is the great consolidation.
And that consolidation is so necessary because, structurally, the valuations are built on shaky ground.
Okay.
Well, blockchains like Ethereum, they trade at these insane software multiples. We're talking 200 to 400 times price to sales. And it's based on what one report called casino revenue, just cyclical transaction fees.
Right. You compare that to a real cash flow machine like NVIDIA, which trades at, 40 to 45 times PE.
It's a world of difference. For Wall Street to ever take these valuations seriously, crypto needs to consolidate around protocols that generate real, predictable fees, the so-called super app models.
And the innovation we're seeing is going right at that problem of fragmentation and efficiency, like the launch of 1-inch Aqua.
Right, which is designed as a foundational liquidity primitive.
Okay, hold on. Foundational liquidity primitive. Can you just break that down for me in plain English? What does it actually do?
Absolutely. Its whole goal is making capital more efficient. It gets rid of fragmentation by letting every single wallet act as its own self-custodial automated market maker, an AMM.
Okay.
So normally if you put $1,000 in a liquidity pool, that money is just stuck there in that one pool. With 1-inch Aqua, that same $1,000 can be used to power multiple trading strategies at the same time, all while staying in your own wallet. It's like using one tool to do 5 jobs at once.
That's a huge efficiency gain. But we're also seeing literal consolidation too, right? Like protocols merging.
Yes, like the merger of Aerodrome and Velodrome into one big entity called Aero.
And that's about centralizing liquidity on base and then expanding out from there.
Exactly. Unification is the key word. They aren't just merging tokens, they're merging liquidity and, more importantly, expanding how they make money.
Beyond just swap fees.
Way beyond. They're trying to capture revenue from front-end routing, from MEV auctions, cross-chain bridging, all of it. And they want to direct all that value back to the Aero token holders. They're targeting a $7 billion market of revenue.
No, that's how you get reliable revenue streams. Okay, let's shift to utility, because this is where it gets really interesting. We're seeing the build-out of a decentralized AI stack. A DAI stack.
And this isn't just theory anymore. It's being built with real interoperable layers.
So how does it work?
It basically mirrors the traditional internet, but it's for autonomous agents, not just people. It's got 3 main parts. Buy 402 handles payments with stablecoins.
Okay.
ERC 8004 is like an on-chain phone book using these NFT-based agent cards as IDs. And then the A2A protocol is how they all talk to each other.
Let's do a quick analogy here so we don't get lost in the jargon. Give me a real-world example.
For sure. Imagine you tell your digital assistant to buy you a new fridge.
Right.
Instead of you having to search Google and call your bank, the DAI stack lets that assistant handle everything. It uses the phone book to find a verified appliance agent. It uses the communication protocol to negotiate the price and delivery. And then it uses the payment layer to send the stablecoins directly on chain.
So you're building an entire economy for digital agents.
Exactly. Where they can buy and sell services all on their own with no centralized company in the middle. That's real tangible utility.
So let's move to probably the hottest topic in finance right now. Stablecoins. The pitch to consumers is incredibly compelling. We're seeing Aave launch an app offering up to 9% on stablecoin balances.
That pitch is all about accessibility and yield, isn't it?
It is.
They're combining these yields that are way higher than a bank's with features for normal people, email signups, built-in wallets, and this is key insurance-backed deposit protection up to $1 million per user.
That puts DeFi on a competitive footing with, the big fintech savings products.
Immediately.
That yield sounds amazing. It sounds very accessible. But we have to talk about the elephant in the room, the structural risk.
Yeah.
Because stables are not all the same. Their risk is totally different.
And the problem is the core failure pattern is kind of depressing, hasn't really changed in 5 years. It's always unsustainable yields and these circular dependencies.
And we just got a huge reminder of this with the collapse of stream finance.
A huge one. It exposed a recursive lending fraud.
Okay, explain that simply. What is recursive lending fraud?
It's basically like modern fractional reserve banking gone completely wild.
Whoa.
Stream finance took only $1.9 million in real collateral in USDC, and then they used that tiny amount to mint and back $14.5 million of their own stablecoin, XUSD.
So they were massively over-leveraged.
Massively. So when the collateral couldn't cover the promises, the whole thing just melted down.
What were the losses?
93 million in direct losses, and then that cascaded into 285 million in contagion across other platforms like Elixir and Euler.
So when one fails, it can take down others with it.
The circular dependency just amplifies the damage across the whole ecosystem.
Which is exactly why regulators are so focused on this. We're seeing big moves from the Basel Committee. Can you just quickly remind us what the Basel Committee is?
Yeah, they're basically the global rule makers for banking regulation, a group of central bank governors.
They're having to rewrite their crypto rules.
They are. They're being forced to rework their 2021 rules because the US and the UK just flat out refused to implement them.
Why?
The old rules were too blunt. They treated something volatile like Bitcoin and a low-risk stablecoin exactly the same. Regulators finally admitted that stablecoins are now too big and have a unique risk profile that needs its own set of rules. So they had to pair it all up and start again.
And the focus in the U.S. is, it's very geopolitical. This isn't just about protecting consumers.
No, it's about global dollar dominance.
Right. Former officials are now saying that stablecoin growth, which could hit 2 to 3 trillion by 2030, is going to create this massive, unending demand for U.S. treasuries.
That is the core insight. Tether and Circle, just those two, already hold more U.S. treasuries than entire countries like Germany or Saudi Arabia.
Wow.
And that growth could actually lower U.S. interest rates by maybe 40 basis points because there's so much structural demand for U.S. debt. It basically reinforces the dollar's dominance through decentralized rails.
But at the same time, the utility for everyday people is still a really positive story. You know, beyond the geopolitical chess game, crypto is actually helping America's 6% underbanked population.
Absolutely. People are using stablecoins for savings, for cross-border payments, because for them, it's just faster and more reliable than the banking system they have access to.
So if we zoom out here, the biggest takeaway seems to be what some are calling the real supercycle.
I like that framing.
It's not happening in the crazy price charts that scare everyone off. It's happening quietly in the fundamentals.
That's the necessary shift, right? The purely speculative tokens are, mostly dying off or consolidating.
But the critical infrastructure.
Yeah, Ethereum, Solana, stablecoins, the DeFi protocols that actually generate real fees, they're all hitting new highs in usage and total value locked. The tech is starting to hit escape velocity.
And the integration is wiring stablecoins right into everyday life. Like Grab, the huge super app in Southeast Asia.
Used by hundreds of millions.
They're putting a stablecoin wallet right inside their app. And MasterCard is extending their crypto credential program to Polygon, giving people human-readable wallet names.
Which makes crypto feel much more like a normal bank transfer.
But this push for mainstream adoption is clashing directly with this big global push for regulatory oversight, isn't it? It threatens the whole permissionless idea.
It really does. You see the White House looking at the international CRF standard to fight tax evasion and the new 1099-DA forms in the U.S. I mean, that's pretty much the beginning of the end for crypto anonymity for U.S. taxpayers.
And internationally, you have that controversial law in the UAE that critics say effectively bans self-custody wallets.
Right, because it criminalizes facilitating unlicensed financial activity, which makes it legally very risky to just run open-source wallet software.
It's just this constant tension, isn't it? The dream of open, permissionless systems versus the reality of global finance and tax compliance.
The irony is just, it's so rich. You have Kraken confidentially filing for a massive U.S. IPO, which is total absorption by traditional finance.
And at the same time, ETH staking hits another all-time high.
The system is both centralizing through these regulated on-ramps and decentralizing at its core.
So here's a thought for you to chew on as we head towards early 2026, a time when a lot of analysts think the ETH chart is going to consolidate and make its next big move.
Okay.
If global finance is starting to depend on stablecoins to prop up U.S. dollar hegemony, and institutions like Harvard are treating Bitcoin like a blue-chip stock, does the long-term success of these decentralized systems now depend more on political lobbying and strict compliance than on pure permissionless innovation?
That's the question that defines the entire space right now.
Thank you for taking this exploration with us. We'll catch you next time.
Spoken Tech for your ears.